Home buyers have been feeling the pressure in this real estate market. The retail real estate market is actually going pretty strong this year. REITs, many of which rent property space to retailers, have seen strong leasing and profit activity this year, with one REIT, Federal Realty, actually seeing their portfolio leasing increase year over year to now being 94% leased. Joining us now is Jeff Burks. He's president and COO of Federal Realty. Jeff, thank you so much for being here. So Diana talks about how some are calling for a home recession, which makes me feel a little nervous about the American consumer, the American homeowner's psyche. But your numbers are pretty good. What's going on with your retail tenants? If you can lease the space, it seems they must be selling their goods.
Yeah, that's right, Courtney. And thanks a lot for having me this afternoon. I really appreciate it. And you hit the nail on the head. You know, in our business, the rubber really hits the road with leasing. And coming out of the pandemic, we've had 4 to 6 quarters of really, really strong performance in our leasing. Last quarter, in fact, we had a record number of deals closed by our leasing team. We're 94% leased. If you look at our small shop space, which is maybe a little bit more sensitive to what's going on in the economy, the occupancy in that space is up 360 basis points year over year and almost 600 basis points since the depth of the recession. And let me give you a little bit of context on why I think that is. I mean, we've been around for a long time. In fact, we were on the floor of the exchange a couple weeks ago celebrating our 60th year and our 55th year of consecutive dividend increases, due in large part to where our properties are located. We operate 25 million square feet of open air retail space and 105 properties in the major markets on the East Coast: Boston, New York, Philadelphia, Washington, D.C., and South Florida, and the Bay Area, LA, and San Diego on the West Coast. And within 3 miles on average of our properties, there's over $10 billion of income being generated. So there's a lot of people, a lot of money. These are built out supply constrained areas. So when you have those kind of dynamics, tenants do very well. And when space opens up in our properties, and space was opened up as a result of the pandemic, the better tenants fly to quality and unfill the space. And that's what we've seen happening now for the last year and a half or so coming out of the pandemic.
That makes sense, of course. And real estate, location is everything. And being located close to a consumer that can pay for goods certainly helps in retail real estate. What does your tenant mix look like as you're signing these new leases? Are they sort of non-traditional tenants for the space? We hear a lot about different service operations going into traditional shopping areas.
Yes and no. I mean, we've always been very, very careful about a couple of things in our portfolio. One is having a lot of diversity. We have 3,100 tenants in our portfolio. No single tenant accounts for more than 3% of our base rent that we collect. And I think there's only 7 that account for more than 1% of our base rent. And then we've always been, and there's more art than science to this, we've always been very good at merchandising our properties and putting a good mix of tenants in that really meet the needs of the local market and the trade area, the consumers that come to that property. And we've seen, whether it's on the East Coast, the West Coast, we've seen really strong, broad-based demand from a broad group of tenants. And certainly some of that is service-based, but we've seen a lot of apparel demand, a lot of food and beverage demand. It's really been very broad-based and no geographic specificity, if you will, to that demand. It's been throughout our portfolio.